The last time this happened, 4 major banks collapsed within weeks and the banking system nearly imploded. Now the warning signs are flashing again. We're going to head over to Japan today because I want you to see this is a global liquidity crisis and it's rapidly spreading to the United States. The risks are high. We could see banks fail at any time. The Price is Right is JGB liquidity crisis is a global warning. Why is the global bond market telling us that banks can fail? Because if you think back to 2023, what happened? We found out that a lot of banks were insolvent, but the cause of this goes all the way back to the pandemic when banks were buying bonds at ultra low interest rates. Problem is, central bankers went on an aggressive hiking cycle, and now those banks become upside down. They become insolvent when they run out of cash. And right now, the global financial system, what we're seeing is liquidity dry up, and quickly, the banks being upside down on their bond portfolios can't sell them without a loss to get cash. And what we're facing is another potential March event where more banks could fail. Liquidity in the JGB market is deteriorating as heightened inflation expectations become entrenched, while disorderly rises in Japanese bond yields leave U.S. and global assets exposed to drops in price. And for banks, this is a dangerous situation because all it does is exacerbate their situation where they're upside down on their bond portfolios. And they desperately need to see interest rates come down. They need to see these bonds mature so they can buy higher yielding instruments. But the problem we continue to see is liquidity is drying up, and banks have no option to react. And keep in mind, since March of 2023, what did the Fed do? Well, they came out and gave the banks an emergency lending provision. Problem is, that's gone. Japan has a problem as well as a lot of other countries. Its long-term bond yields have climbed sharply this week, reaching new highs in the 30 and 40-year issues, with liquidity in the JGB market worsening significantly. We're seeing the same things happen here in the U.S. We even know the Trump administration has been talking about this as Treasury Secretary Scott Bessent told Fed Chair Powell, look, we need to relax the supplemental leverage ratio rule for the banks. And why do we need to do it? We need them to buy bonds because right now, no one else is. Anecdotally, JGB trading desk talk of challenging conditions. The tail of the 20-year auction this week, i.e. the gap between the average and the lowest accepted prices, was the longest since 1987. And so what you're seeing from an investment standpoint is investors don't want to touch long-term bonds. And there's a really good reason for it because they believe inflation is going higher. And when you start to look at long-term interest rates, it's a function of inflation and growth expectations. Right now, inflation on the forefront of investors' mind. Their belief, inflation goes up, rates go up, they'll buy, but only when they see rates go higher. Depleting liquidity is corroborated by Bloomberg's index for Japanese bonds, which looks how far JGBs trade from an idealized yield curve. The indicator is just below the level it reached after Lehman went bust in 2008, this time accompanied by a bear steepening of the yield curve. And this is a dangerous situation we're facing here because it's not just the Japanese bond market that's getting worse. We're seeing liquidity issues even in the U.S. markets. And what we're seeing in the liquidity index is a sharp rise, meaning liquidity is deteriorating. Here in the U.S., we just had a 20-year bond auction yesterday, and what was the reaction? The same thing that we're seeing in JGBs, and what did that lead to? Stock prices down, bond prices down, dollar down. Everybody's starting to panic because liquidity is drying up, and this is a major problem. But just because the liquidity is deteriorating in the JGB market doesn't mean it has to deteriorate in your trading account, because right now liquidity is behind uranium, and we told our subscribers to our CTA Timer Pro Report, buy uranium on April 24th at the open. They're up 17.72% as of yesterday's close. We think there's potentially another 5 to 12% upside. We'll look at the charts at the end of the show, but you too can get on this trade and our next big trade. Grab the links in the description below. Use a coupon code for your free 30-day trial. Learn how to beat the machines and win. The BOJ does not see a need for intervention despite its own survey on bond market functioning. And this is absolutely baffling to me. They're literally watching liquidity dry up at the longest end of the curve. They're seeing a shock in interest rates. This is impacting the banks and the financial system. It's a major red flag. It's spreading here to the U.S. And the response from the BOJ and so far the Federal Reserve is we're going to do absolutely nothing. And this is a problem because if interest rates on the longer the curve go up, it's going to have an impact on equity prices all across the world. And again, could lead to insolvencies in the banking system. And again, their issue here is banks are upside down on their bond portfolios. They can't sell them to get cash when liquidity dries up. And that's exactly what we're seeing here in these auctions, is there isn't liquidity or demand. There's a decline in every single subcategory in the latest quarter, with the overall measure of bond market health only a hair's breadth above its 10-year and series low. So what we're seeing across global bond markets is that there's a major problem. We're seeing liquidity issues start to build in the system, and those that are in charge of it, the central bankers, are doing absolutely nothing here. And this is a major problem, because if it continues to get worse, and it may not take much, what you could see is a wave of bank failures and insolvency spread all across the global financial system. The elephant in the room remains inflation. It has remained persistently elevated since the pandemic. But even more alarmingly, though, is the acceleration of new highs of inflation expectations of businesses and consumers, as also seen in the U.S., risking an unanchored rise in prices if expectations begin to drive the CPI higher. Now, the problem is it doesn't always lead to that. Consumers' view of where inflation goes and where it actually goes are often two different things. But we need to be understanding the situation here very clearly, is that consumers believe inflation is going higher, and that's transmitted into the investment world. So what that means is rates must go higher, and all of a sudden everyone's saying, look, we don't know how high inflation can go, and we would love to buy bonds, but we're going to wait it out. This is a major problem, because what you're seeing is leading to liquidity issues in the financial system, putting stress on global banks. Household inflation expectations from the BOJ survey of the general public show little sign of halting their ascent. One-year inflation expectations are at a whopping 12%, while the average price rise expected over the next 5 years is almost 10%. And yet when we look at the data, we've heard from Walmart, Target, Home Depot, Lowe's, what are they all saying? Look, prices are going up maybe a little bit, but we're not pushing prices onto consumers. We even heard from Amazon today. They're not really seeing a big change in consumer spending or inflation, but so despite the fact that there's all this fear that tariffs are going to drive an unsustainable move in inflation that's going to happen year after year, the real evidence is it's not there. But the problem is it's the fear of it's happening that's driving the bond markets. And if rates continue to go up, what you could see is another repeat of what happened back in March of 2023, only this time likely to be bigger and lead to more bank failures. Let's take a look at the relationship between the University of Michigan inflation expectations. This is from consumers against 30-year Treasury yields in red. And what you can see, starting after the financial crisis, there's a much tighter relationship between the two. And you can see that inflation expectations certainly led the 30-year yield higher following the pandemic. But what happened after that? Inflation expectations came down, but yields didn't. Investors still believe somehow that rates needed to go higher. Central banks didn't lower yields. This time, you're seeing a massive spike in inflation expectations, and that's flowing right into the bond markets here and is causing chaos in the financial systems. One, again, that could lead to an all-out liquidity crisis at a time when we're facing, of course, central bankers who are worried about inflation and can't see that the system right now is facing major cracks. The majority of investors and consumers in Japan have never had to contend with inflation much above 1% for most of their lives. But believe it or not, when they move to preserve their purchasing power, this is a key point here, the impact on inflation and yields amplified by the BOJ's duration-laden balance sheet has a potential to be systemic. And it won't just be Japan's problem. That's the real issue here. It already spilled over into the U.S. We saw that in the 20-year auction. We're already seeing yields move higher. We're seeing liquidity conditions start to dry up in the financial system, which is why stock prices came down yesterday. So there's a lot of risk here. And again, central bankers appear to be doing nothing when they should be doing everything to get this under control. But the real issue when we talk about inflation expectations is not what consumers' view is, it's just how fat their wallet is. And when you take a look at average weekly hours of production of non-supervisory employees in red and overlay it against inflation expectations, what you find out is that when paychecks shrink relative to inflation, well, expectations are one thing, but reality is another. Let's take a look at the global financial crisis, because I think this is a very good mimic of what we're seeing right now. Energy prices drove expectations expectations and inflation higher. But what was the problem? When you think about consumers, they have to spend money on energy, food, and rent. Everything else becomes discretionary. So when one part of their budget that they have to spend money on, like energy, goes up, what happens? It means that less money gets spent elsewhere. So views of inflation become transitory, but they become very real to people spending money. And the next thing you know, they roll over and come crashing down, particularly because what happened at the same time, average weekly hours were on a downtrend. So not only were consumers dealing with higher energy prices, they had even less money to spend on the things they'd wanted to. Next thing you know, all out financial crisis. And now look where we're at. Consumers say, look, inflation's going to shoot higher. The problem is their paychecks aren't. They're not getting the hours. We've been hearing from survey after survey that hours are going to be the first thing that gets cut. We saw this at the Port of Los Angeles, who said, look, we're not going to lay any money off. But when all of a sudden 30% fewer ships showed up, a lot of people got absolutely no hours. So again, no hours, no money, or even fewer hours, less money means inflation doesn't last. But if you want to really know where inflation expectations come from, we go to look at gas prices. That now shown in red. You can see the relationship going back in the global financial crisis as they moved higher and lower together. And now look, gas prices really aren't budging. It's the expectations of tariffs. But yet the evidence that this is being passed through to consumers, at least in a meaningful way, is very light at this time. Now again, expectations mean we're going to see a lot more inflation and in the years to come. Of course, we know even the Fed has said we think this is transitory, and they're right, because the cure for higher prices, my friends, is higher prices, particularly when paychecks are not rising enough to afford it. And now what we're seeing, what started in Japan, is quickly spreading to the US. As long-term bond yields now soar globally on fiscal policy fears, so what started out as a liquidity issue is now turning into a government spending issue. You may recall over the past years, I mentioned that when we go into the next downturn, one of the biggest risks the global economy faces is that governments around the world continue to spend. They didn't bring their deficits down. They didn't bring their debt levels down. And when things slow down, there's going to be a pain period, a punishment for their fiscal aggress. Well, we're seeing it now. 30-year bond yields this week traded above 5% in the U.S., not far from their highest since 2007, while those in Japan reached the most since records began in 1999, with auctions in both countries running a tepid demand, again, as investors say, look, I'll buy, but not until I'm being compensated for inflation expectations. Long-dated bonds in the UK, Germany, and Australia have also come under selling pressure. Investors are warning that governments can't keep borrowing at the pace they did when interest rates were close to zero, particularly since trade tensions and sticky inflation have diminished the probability that policymakers will dramatically ease monetary policy. So all they're saying here is very simply, look, everybody thinks inflation is going up. The Fed then buys into this too and says, look, we have to control demand. We have to keep monetary policy in a restrictive point. We're going to keep interest rates up. That's adding only fuel to the fire of higher rates, because some people believe if inflation goes high enough, central bankers are going to raise rates. Now, we know in practicality, it's not going to happen because, again, paychecks aren't going up enough to support higher prices, at least in the short term, though. Central bankers don't appear to be budging or have any sign they will. A pullback by central banks and pension funds from bond markets also means a once dependable source of funding is increasingly absent. This is, again, you go back to what Treasury Secretary Scott Bessent said. Look, we've got a big tool in our box that we could wield. It's called a supplemental leverage ratio. The big banks want to buy bonds right now. The problem is they can't. The reason they can't is because the laws require them to hold cash against things like Treasury securities, which are considered to be completely risk-free. All the Fed has to do is relax the rule, and the bankers already said, we'll buy bonds here. It's no wonder that buyers are wary of feeding unsustainable deficit levels for the world major economies. And so now, after Moody's downgraded the U.S., what do we see is the bond markets are telling governments around the world, you want to keep spending? There's a price to pay. It's not just inflation expectations. You need to bring your fiscal house in order. But when we see periods where there's slowing growth and rising inflation, we know what that's called as stagflation is building as we go into a recession. We can see that as we look at the CPI in blue against real GDP in red. What do you see back in the late 80s? Growth was slowing. At the same time, prices are rising right into a recession. See that happen during the dot-com bubble, obviously the global financial crisis, and now what are we facing? Very clear signs that growth is going to slow. Inflation expectations telling us the CPI is going to go higher, but the odds of it going up meaningful at this point because demand's getting crushed, well, actually is pretty low in my opinion. Parallels are being drawn with the U.S. in the early 90s, Euro area in the 2010s, and the U.K. in 2022, when the so-called bond vigilantes drove the cost of money up so much that governments were forced to retrench. Just last month, President Donald Trump diluted his plan to impose tariffs amid what he calls yippee bond markets. Here's what I want to know from you. Do you think the bond markets are giving the government and the Trump administration a very clear message that they need to cut their spending back? Do you think the government should go ahead with the plans and pay the big price for this based on what we're seeing in the tax package? Weigh in the comments below. What are your views? The concern over fiscal policy is also undermining the dollar, which would typically gain when yields rise. So right now, that's a secondary issue as we're seeing a weaker dollar. We know that could backfeed into inflation. And right now, everybody seems to be turning their back on government debt. In this case, the U.S. dollar, because we're seeing global trade slow down. That means dollars are getting trapped inside the U.S. financial system, ultimately can lead to inflation. Because remember, while everyone else exports deflation, we export inflation by getting dollars out of our financial system. Now they're getting trapped. So we're running a potential risk. If it's not the tariffs that cause inflation, it could be the dollar. But don't worry, if that happens, tariffs will get the blame. Jamie Dimon of JP Morgan Chase turns and warns that U.S. stagflation risk says Fed is a right to hold, and that is the risk right now, because when you get slowing growth, rising inflation, and shrinking paychecks, next thing you know is the labor market comes unwound. But don't worry, the Fed said they'll react, but maybe not till later this year. If we can get the tariffs down closer to 10%, that's all sealed and done, delivered by July, well, then we're in good shape for the second half of the year, Waller said. We're in good position at the Fed to kind of move with rate cuts to the second half of the year, suggesting that they know inflation's coming down. It's very obvious they can see it, but they're worried about the tariffs. If it wasn't for the tariffs, the Fed probably would be cutting right now. Economists broadly expect Trump's trade policies to drag down economic growth and put upward pressure on inflation, even with the temporary reduction in tariffs against China. Waller reiterated he expects any increase in inflation-related tariffs to be temporary. It's obvious why. He knows the labor market is getting weak here. He knows paychecks are shrinking. He knows the data is very clear. When that happens, what we see is inflation become transitory because consumers can't afford higher prices. But the real risk is if this rise in bond yields doesn't get under control, not only is it going to lead to less consumer spending and business spending, it could lead to a massive liquidity crisis and lead to more bank insolvencies. But just because money's flowing out of the bond market and the dollar doesn't mean it can't flow into your trading account. Check out this trade on uranium we put back on April 24th to our CTA Timer Pro subscribers. We told them buy on the open right here. And why did we know that? Not only did we see the technical setup of an inverted head and shoulders, but we saw the potential that machines were likely to be big buyers here, and they were driving up the price and putting money in our subscribers' pockets. We still think there's another about 5% move up to this supply zone, and from there a potential 10 to 12% move higher up to 33, given more upside as machines look to continue to buy and investors play chase. Now you too can get in on this, and if you want to beat the machines, if you want to trade and win, let me tell you how we do it each and every day. We look at the machine positioning across the broad equity, bond, currency, and commodity markets, and when a signal trips, we've already back tested it, so we know which one of our signals are the highest probability of putting money in your pocket. And that generates on the hot list each and every day. And you still get the machine position across all the different sectors. You get the whole report. You get all the tradable signals. You get my opinion on the best trades to take. We give you risk control levels, a full tracking of all of our open trades and returns, a weekly update. And here's the best part of all. We don't want you to put a dime out to try the report. And why is that? Because we're so confident you can make money trading against machines and winning. We want your first 30 days to be on me. Grab the links in the description below. Use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.